price as a signal of health and start watching flow. A falling paper price no longer signals weakness. It invites buyers and accelerates metal leaving Western vaults for markets like Shanghai. Old tricks that relied on shaking confidence no longer work because scarcity drives behavior, not fear. Silver responds to need, not psychology. Inventory behavior has shifted dramatically. Companies no longer treat storage as waste. They view it as insurance against shutdowns and political risk. China learned this fastest, quietly stockpiling for years rather than months. Metal enters bonded warehouses, disappearing from global visibility while reserves quietly grow. Western analysts miss this because they rely on visible imports and exchange data. They assume low data equals low demand, not realizing that strategic hoarding has replaced transactional buying. Silver moves east, and pressure reappears in American markets. Lead times stretch, suppliers become rigid, and even priority industries compete for the same pool. Inflation spreads through physical goods, not just prices. Once silver is absorbed into long-term reserves, holders won't sell without replacement. Paper prices and physical reality diverge. Volatility on charts misleads. Temporary dips only accelerate accumulation, locking metal into infrastructure rather than trade. Paper markets grow relative to the physical base. Confidence erodes when delivery becomes inconvenient, detaching premiums from spot prices. Industrial users adapt silently with long-term agreements and buffer inventories. Western policymakers underestimate the intent behind these moves, creating a dangerous lag before shortages become obvious. By the time scarcity appears in public data, the metal is already claimed. The market doesn't fail suddenly. It is pre-allocated quietly. When too many claims chase volatility in paper markets, delays the signal that scarcity is real. That delay encourages continued overuse of futures as a substitute for physical ownership. And when the signal finally breaks through, the adjustment is sharper than it would have been otherwise. Not because demand suddenly exploded, but because supply had been quietly locked away for years. As silver continues moving east and into long-term reserves, the West faces a choice it has not yet fully confronted. Compete on price and availability, or accept reduced access. Competing means higher prices, long-term contracts, and a willingness to prioritize physical security over short-term cost efficiency. Accepting reduced access means slower innovation, higher production risk, and growing dependence on external supply chains that are increasingly politicized. Neither option is comfortable, which is why denial persists. It's easier to believe that price action is temporary, that markets will normalize, that inventories will reappear when needed. But normalization requires surplus, and surplus requires years of investment, stable permitting, and predictable demand signals. None of those conditions exist today at the scale required. Even new supply, when it comes online, is often pre-sold, hedged, or absorbed by the same long-term buyers who are already building reserves. This is why the silver story isn't about a single spike or a single shortage. It's about a gradual transition from abundance to allocation, from markets that clear through price to systems that ration through access, from speculative narratives to operational realities. Once a market crosses that threshold, behavior changes faster than production can respond. In that environment, the most important movements are the quiet ones, the contracts that don't make headlines, the shipments that bypass exchanges, the inventory decisions made in boardrooms rather than trading floors. These are the forces reshaping the market, not the daily candles on a chart. And they don't reverse just because price goes down for a week or a month. By the time the broader public recognizes what's happening, silver will already be embedded where it's needed most, and unavailable where it's merely wanted. At that point, the conversation won't be about whether the price is too high. It will be about whether supply can be secured at all. And history suggests that once markets reach that stage, the adjustment is not subtle. At this stage, the silver market is being driven less by speculation and more by fear of interruption. Not fear in the emotional sense, but institutional fear, the kind that shows up in procurement policies, reserve mandates, and long-term planning models. Once industries begin modeling scenarios where silver is simply unavailable at any price, their behavior shifts permanently. They stop asking, what is the cheapest way to source metal? And start asking, what is the safest way to guarantee continuity? That question has only one answer: ownership and control. This is where traditional market logic completely breaks down. Classical economics assumes substitutes, flexibility, and demand destruction at higher prices. But silver has very few true substitutes, and most of them fail at scale or efficiency. You can redesign components, reduce usage marginally, or optimize recycling, but none of those solutions replace primary supply fast enough to matter. Recycling itself depends on past abundance, and much of that silver is already dispersed in products that won't return to the market for decades. So when demand tightens, it doesn't disappear, it competes. Competition for a scarce input does not behave like consumer demand. Consumers can delay purchases. Factories cannot delay production indefinitely. Governments cannot delay defense readiness. Infrastructure projects cannot pause without cascading costs. So higher prices do not eliminate demand. They simply determine who gets priority. And increasingly, priority is being decided long before metal ever touches an exchange. This creates a silent hierarchy in the market. Those with long-term contracts, political leverage, or strategic reserves operate in a different reality than those relying on spot availability. On paper, everyone sees the same price. In practice, not everyone has access. Some buyers pay premiums that never appear on charts. Others accept delayed delivery without complaint because they still have buffer stock. And some are quietly shut out, forced to redesign products or reduce output without ever admitting that silver was the constraint. The financial system struggles to process this reality because it was built on abstraction. Futures, options, ETFs, all designed to provide exposure without possession. That abstraction only works when the underlying asset is plentiful enough that delivery is a formality. When delivery becomes strategic, abstraction becomes dangerous. Claims multiply faster than metal, and the gap between what exists on balance sheets and what exists in vaults widens. This is why confidence is the real currency now. Not confidence in price stability, but confidence in settlement. The moment participants begin doubting whether paper claims can be reliably converted into metal, behavior changes rapidly. They shorten time horizons. They move off exchanges. They demand clauses that guarantee physical allocation. Each defensive move reduces liquidity further, making the system more fragile, not less. What makes this especially unstable is that the transition is nonlinear. For a long time, nothing appears wrong. Deliveries still happen, prices still trade, analysts still publish reports explaining why shortages are exaggerated. Then, suddenly, a small disruption exposes how tight the system has become. A shipping delay, a refinery outage, a surge in industrial orders, and what would once have been absorbed by surplus now triggers a scramble. In that moment, price becomes almost irrelevant. And the question is not how much does it cost, but who already has it. Those who prepared early look calm, those who didn't look irrational. From the outside, it appears like panic. From the inside, it's simply the consequence of delayed recognition. The flow of silver toward regions that prioritize stockpiling over trading accelerates this process. Metal that enters long-term reserves does not cycle back through the market. It is effectively removed from price discovery. That makes remaining supply more sensitive to shocks. Every additional ounce locked away increases the leverage of the next disruption. And because this locking happens quietly, most models fail to account for it until it's too late. This is also why official reassurances often miss the mark. Statements about adequate supply are based on production numbers and visible inventories, not on availability under stress. But availability is conditional. It depends on willingness to sell, logistical capacity, political alignment, and contractual priority. When those conditions tighten simultaneously, supply can vanish without mines shutting down. In that environment, the idea that markets will naturally rebalance becomes optimistic at best. Rebalancing requires time. Time to invest, time to build, time to permit and refine. But the demand for silver is happening now, embedded in technologies and policies already in motion. Energy transitions, electrification, defense expansion, these are not optional programs that can be paused easily. They are commitments already made. So the market adapts the only way it can, by shifting from open exchange to controlled allocation, from visibility to opacity, from price-led signals to security-led behavior. This is not a temporary phase. It is a structural change. And once markets cross into this mode, returning to the old system requires a surplus so large that confidence is restored for years. That kind of surplus is nowhere in sight. What we are witnessing is not the end of the silver market, but the end of its old assumptions. The assumption that price weakness equals oversupply. The assumption that inventory is waste. The assumption that paper claims are interchangeable with metal. Those beliefs were products of a different era, an era of slack, not strain. Now the system is tightening quietly, relentlessly, and the most important signals are not found in headlines or daily charts, but in where silver stops moving once it arrives. When metal stops circulating, markets stop behaving normally. By the time that becomes obvious to everyone, the transition is already complete. As this tightening continues, the market enters a phase where reactions are driven by anticipation rather than events. Participants no longer wait for shortages to appear before acting. They move based on the expectation that access will worsen. This forward-looking behavior pulls future demand into the present, compressing years of buying into shorter time frames. On paper, it looks like sudden surges. In reality, it's delayed action finally catching up with risk. This anticipation effect is especially powerful in silver because supply cannot respond quickly. Mining is slow, capital-intensive, and increasingly constrained by regulation, energy costs, and declining ore grades. Even when prices rise, production does not surge overnight. Most silver is produced as a byproduct of other metals, but inventory, risk, and access, and a steady erosion of the idea that markets alone can resolve physical constraints. By the time these dynamics are fully reflected in mainstream analysis, the structure will already be different. The silver market will still exist, prices will still trade, but the rules will have changed. Ownership will matter more than exposure. Access will matter more than price. And preparation will matter more than prediction. What ultimately defines this phase is that the silver market is no longer clearing through excess, but through restraint. Supply still exists, mines still operate, refineries still run, but the willingness to release metal freely has diminished. That change is subtle, yet powerful. Markets can tolerate low inventories if confidence is high. They cannot tolerate low inventories when confidence is fading. And confidence fades not because of one failure, but because of repeated small frictions that signal fragility. Each time a buyer is told to wait a little longer, pay a little more, or accept a different form of settlement, a mental adjustment takes place. The buyer does not panic. Instead, they revise their strategy. They plan further ahead. They reduce reliance on intermediaries. They seek direct relationships. And most importantly, they decide to hold on to what they acquire for longer than before. This behavior compounds across the system. As holding periods extend, circulation slows. Slower circulation means that the same amount of metal supports fewer transactions. That is functionally equivalent to a reduction in supply, even if production numbers remain unchanged. Economists often overlook this because they focus on flows rather than dwell time. But in tight markets, dwell time matters as much as output. Metal that sits idle in a strategic reserve is metal that no longer stabilizes the market. This also explains why traditional signals fail. Inventories might look adequate in aggregate, yet unavailable in practice. Prices might appear range-bound, yet access becomes increasingly restricted. These contradictions confuse observers who are used to clean cause and effect relationships. But the system is no longer governed by simplicity. It is governed by risk management. Risk management favors redundancy over efficiency. It favors possession over promise. It favors long-term certainty over short-term optimization. Once industries adopt this mindset, they do not revert easily, because reverting requires believing that the future will be more stable than the present. Few decision makers are willing to make that assumption after recent years. The longer this persists, the more the silver market stratifies. At the top are those with secured supply, insulated from spot volatility. Below them are those with partial coverage, constantly adjusting and renegotiating. At the bottom are those exposed entirely to market swings, forced to react rather than plan. This stratification reshapes competitive landscapes. Success becomes less about innovation alone and more about input security. Financial markets struggle to price this reality because it doesn't resolve cleanly. There is no single equilibrium price that restores balance. Higher prices do not magically unlock hoarded supply. Lower prices do not reduce strategic demand. Instead, price becomes a secondary variable, reflecting tension rather than resolving it. That is why attempts to engineer price outcomes feel increasingly ineffective. Over time, this tension manifests in unexpected ways. Sudden spikes in premiums, abrupt changes in contract terms, quiet withdrawals from exchanges. None of these events, on their own, confirm a crisis. Together, they outline one, a crisis not of collapse, but of transition. From a market optimized for trade to a system optimized for security. This transition is uncomfortable because it exposes assumptions that were never tested under stress. The assumption that liquidity is always there. The assumption that contracts guarantee access. The assumption that global supply chains self-correct. When those assumptions weaken, participants do not wait for proof. They adapt preemptively. And preemptive adaptation is what drains flexibility from the system. What remains is a market that still functions, but with less forgiveness. Errors are punished faster. Delays ripple wider. Small disruptions carry larger consequences. This brittleness is not obvious in calm periods, but it defines outcomes when pressure rises. And pressure does not need to come from a single shock. It can accumulate quietly through policy, technology, and geopolitical drift. In such an environment, the most valuable asset is not information about price direction, but understanding of structure. Who controls supply? How long inventories are intended to last? Which flows are transactional and which are strategic? These factors determine resilience far more than any short-term forecast. As silver continues to be absorbed into long-duration uses and reserves, its role evolves. It stops being just a traded input and becomes a foundational material whose absence halts systems. Markets do not handle that transformation gracefully. They adjust unevenly, often too late for those who assumed the old rules still applied. Nothing about this process requires drama to be real. It unfolds through ordinary decisions made under new constraints, one procurement policy at a time, one inventory buffer at a time, one shipment redirected, one contract extended. And by the time these decisions aggregate into visible outcomes, reversal is no longer simple. As the transition continues, the market's behavior becomes increasingly determined by long-term security rather than immediate cost. Companies no longer optimize around quarterly results. They optimize around uninterrupted operations, reliable supply, and the ability to meet production targets no matter what price signals fluctuate in paper markets. This mindset is infectious. As more participants adopt it, the logic spreads across industries and geographies, reinforcing the cycle of preemptive accumulation and extended holding periods. Every strategic purchase reduces the availability for others. Each shipment directed into reserves is a shipment unavailable to the broader market. On paper, the numbers might look sufficient. In practice, the accessible portion of supply steadily shrinks. This is why traditional analysis, focused on total mined output or reported inventories, increasingly fails to capture reality. The market's liquidity has effectively contracted, even if total physical silver has not. Meanwhile, the paper market continues to operate under old assumptions. Futures, ETFs, and other derivative instruments assume that metal can always be called, transferred, or delivered. But as physical silver moves into opaque strategic holdings, those assumptions are increasingly invalid. Claims now exceed immediately available supply more frequently, and confidence in settlement becomes a dominant variable in trading decisions. This divergence between paper and physical realities creates stress points that are subtle but cumulative. Spot price volatility may remain moderate, yet premiums for immediate delivery rise. Delivery times stretch. Certain buyers are repeatedly told to wait. Each of these small frictions signals scarcity to those who understand the physical flow, and their responses further tighten the system. The feedback loop continues quietly, invisible to most observers. Smaller market participants suffer first, with reduced access to metal and growing reliance on intermediaries. They must pay more, accept delays, or reduce production. Larger players consolidate influence, further concentrating control over strategic supply. This stratification reshapes competition. Companies that secure supply gain a long-term operational advantage, while those without access face increasing vulnerability. Government policies eventually reinforce these patterns. Strategic sectors are prioritized for allocation, sometimes explicitly, often through incentives and preferential contracts. These interventions further remove metal from general circulation, even if production remains stable. The interaction of private strategy and public policy accelerates the system's structural shift, moving it from a trade-based market to a security-driven one. Over time, price signals become less informative. Traditional economic logic assumes that higher prices should reduce demand and lower prices should encourage consumption. But for essential industrial silver, demand is relatively inelastic. Strategic accumulation and operational necessity dominate. Price movements reflect tension and risk, not equilibrium between supply and demand. The cumulative effect is a market increasingly governed by control rather than cost. Participants focus on resilience over efficiency, ownership over exposure, and certainty over speculation. Mistakes are punished faster, and small disruptions have larger consequences. Liquidity is selective, favoring those with foresight and strategic positioning. By the time shortages or crises are recognized publicly, the allocation of silver is largely set. The adjustment to scarcity occurs unevenly, benefiting those who acted early and penalizing those who relied on traditional market mechanisms.